Okay, so hey guys, welcome back to our Phillip Trading podcast today. So I'm your host for today. My name is Jun Hang here, and I'm the dealer here at Phillip Capital. So with us today, we have a extremely experienced speaker and trader, Mr. Daniel Ang here. So how are you today, Mr. Daniel?
As good as ready.
All right, okay. So now, before we start, so please take note that this presentation has not been reviewed by the Securities Commission Malaysia, and it's just for a general education purpose only. So it's not an invitation to buy or sell any investment product. So hence, the speaker and PCSB are not liable for any financial decision you may make based on the content of this presentation. So, all right, back to the core content today. So this podcast is actually a preview for our upcoming webinar with Mr. Daniel here. So the title will be US rate hikes positive for equity markets. So it will be on Wednesday night, 8 to 9 p.m., 25 September 2024. So if you are interested in the US market outlook for 2024, please do not forget to register for the webinar. So, all right. So before we start, so let me finally introduce our honored speaker today with us today, Mr. Daniel Ang here. So basically, Mr. Daniel is the founder and CEO for Traders Company Academy International Private Limited Company. So the company was founded in 2012 as there are more and more speaking and coaching offers came his way. So he's particularly actively involved in the country of Taiwan, China, South Korea, Japan, and Australia. In 2019, the Chicago Mercantile Exchange (CME), you are known as, contracted him as one of their independent speakers for the Asia Pacific region. So he is also a contracted speaker for European Exchange, where we call it Eurex here. So when the pandemic struck in 2020, so the borders were closed. He used the time to actually write and publish his first book, so-called, I think one of the famous book I have seen across the industry. So the Accidental Trader, so which is available at Books Kiko Kuniya in both Singapore and Malaysia. So he remains as an active trader beside running an ongoing mentorship program, coaching aspiring traders. So today we are fortunate to have Mr. Daniel here with us to share his insight and experience. Well, I won't hold too much on your time, so I will pass it to Mr. Daniel to take over the show from here. So, Mr. Daniel, you may go ahead. The screen is yours. Okay, so you can share
All
your
right,
screen
thank you
right
very
now.
much. Thank you very much, Junhang, for the introduction. I just want to share my screen with you. Hopefully, you can see my screen. Are you able to see my screen?
So far we can never mind. Mr. Daniel, you
You got to
can,
enable the yeah.
yeah, you can try now.
Okay. So today is the first week of September. So we are in that very pivotal moment. We all know September, we're going to have the sixth FOMC meeting for 2024. And this particular FOMC, which is the Federal Open Market Committee, is going to be very crucial because the Federal Reserve is very, very likely to start pivoting, meaning to say they have maintained very high interest rate for quite some time now. And this is possibly the time whereby they will be cutting interest rates. And there will be immense implication, whether for equity markets, for all asset classes, because everything is dependent on what the Fed does, and they are very influential. So I think my light has just gone off. But anyway, right, let's get started. Okay, the FOMC meeting is scheduled for September 17 to 18. It's a 2 days meeting, and on the 18th itself, which ends at 2 a.m. Malaysia Singapore time, then the Fed chairman will come on board to give a prepared text, and then he will take questions from the floor. So during this prepared text and his Q&A session, market will move, and a lot depend on what the Federal Reserve decides at the meeting itself. Like I said earlier on, there's a very high likelihood that the Federal Reserve will decide to cut interest rates. Market has already priced in a 25 basis point or 0.25%. So if there's going to be more than that, for example, 50 basis point or even worse, 75 basis point, how would market react? So this particular podcast is a prelude to what we will be talking at the last week of September, where we were going to have a webinar on this subject again. So this podcast is basically just a teaser, just to let you know what we will be talking about at the webinar itself. Okay. Well, we all know last month, during the Jackson Hole Symposium. Now, every year, the central bankers will gather in this place in Kansas City called the Jackson Hole Symposium, whereby they will powwow and they will talk about monetary policies and their impact on the nation itself. So the start of that meeting itself, the Fed Chairman Jeremy Powell has came out and talked about this. The time has come for policy to adjust. This one simple sentence is already as clear as it is that the Federal Reserve is looking to reverse its monetary policy. So this is going to be critical going into September. We are already in the first week, and we are looking at less than 2 weeks' time, whereby they will be talking about the FOMC. Now, the direction of travel is clear, and the timing and the pace of rate cuts will depend on incoming data. Now, this is, of course, what he has been saying all this while. This is basically just to make sure that if the data comes in and supports a rate cut, then, of course, he will go ahead and do that. But if the data coming in the next few weeks is something else, then of course he has the flexibility to hold off the rate cut for another period. Okay, so this is something that he will do to protect himself just in case the data do not confirm what he wants to do. And the evolving outlook and the balance of risk. So now we have seen after the inflation, the CPI numbers pick out at 9.1% in June of 2022. We have seen inflation right now is already sub 3%, although it is still a distance away from the target rate of 2%. But more or less, we can surmise that the fight against inflation has been rather successful based on the inflation data. So based on this, we will be very clear that the Federal Reserve now is going to shift their focus, because the Federal Reserve has a dual mandate. Not only are they mandated to maintain stable prices, and high prices is definitely something that they are fighting over the last 2 years or so, and it seems to be working for them, and now they are shifting their focus to keeping the economy going. There's a lot of talks about soft landing. What is exactly a soft landing? A soft landing means that it will be there will be no recession and the economy is doing okay, labor market is doing okay. But right now it seems that something else is gaining the attention of the Federal Reserve, no longer the fight against inflation, but I think the market is now gunning towards looking at the health of the US economy. Now, based on the Fed Watch tool, which you can actually access in the CME website, there is that summary in which they will go out and get a consensus from money managers as to how much the rate cut is going to be come September the 18th, because this, like I said, the FOMC is a 2-day meeting on the 17th and 18th. 18th is when they will announce their decision. 55% of respondents to the survey feels that the Federal Reserve will cut 25 to 50 basis points. So this is very much baked into the price. So if the market, if the Federal Reserve finally decides on a 25 basis point or even 50 basis point cut, then there will be hardly be any reaction, because the next logical thing that the markets will be looking for will be what's next. When is it going to be another cut? Will there be another cut in, let's say, October? Will there be another cut for the rest of the year, and by how much? Market has already priced in 4 rate cuts, okay? And there are a lot of talks out there in the market saying that the Federal Reserve may have to cut rates closer to 3%. Okay, right now it's at 5.5%. So if there's going to be 3 to 4 cuts and it can hit just above 3%, then that would be what the market is looking for. However, if the expectation is not there, then of course market will react according to how much the Fed is telling us that they will cut. Now, the other 45% think there will be a much deeper cut of 50 to 75 basis points. Now, if the Fed should cut as deep as 75 basis points, all hell will break loose, because it will be an acknowledgement by the Federal Reserve that the economy is in serious trouble. Now, rate cuts, a lot of people have been talking about rate cuts being positive for equity markets. It is not necessarily the case. If the market is already in a bull market, and if the Federal Reserve cut rates, it will ignite a bull market rally. However, if the perception is that the economy is already in trouble, And if the Federal Reserve cut and they cut deep like 75 basis points, it is telling the world that they are in trouble, and that will not be positive for equity markets. So when you go into the FOMC, just be aware, rate cut is not always necessarily good for equity markets. If the market is about to flip, and it looks like it may have already flipped since the first week of August. Now, if you remember what happened in the first week of August, just 1 month ago, global stock market was actually reeling, okay? And that is, of course, on the basis of a weaker than expected non-farm payroll the Friday before. So this Friday, which is tonight, we're going to go into another into another non-farm payroll numbers, okay? And if this data also show a very weak labor market in a sense there are less jobs being created, or if the unemployment rate surged beyond 4.3%, which is currently where it is right now, then we will probably see the immediate knee-jerk reaction to the downside. So tonight, non-farm payroll will be crucial. So do watch out for this, because that will be 3 weeks before our webinar. So by then, if we talk about non-farm payroll, it may be a little bit too late, okay? So we are looking for signs, okay? Like I say, the Fed chairman is looking for incoming data to confirm what he already see in the inflation front. But right now, his focus right now is on the labor market. And this is something we have to watch. Now, in terms of the inflation fight, okay, the Federal Reserve do not look at the consumer price index. They look at what we call the personal consumption expenditure. This is their favorite measure of inflation in the States. And the core means if they take away the component of the food and energy component, they want to see a more a clear-cut direction in which inflation is heading. From the high here of 5.6% in the core PCE numbers back in February of 2022, now we can see that the last number is at 2.6, although the last three outing, we have seen the PCE numbers, the core PCE numbers has already plateaued at 2.6. Now, 2.6 is not that far away from 2%, okay? So we can almost conclude that the fight against inflation has been successful based on this number. So like I said, the focus now is no longer on inflation. So this is the number that came out last week. So this will be the latest number that we have going into the non-farm payroll. So we will have to watch the next update as far as the PCE number is concerned. But for now, this is the latest number that we have, and it's looking good on the inflation front. Now, if you remember, on August 21st, the US Labor Department, specifically the Bureau for Labor Statistics, dropped a bombshell on the world, okay? They announced that throughout March of 2023 to March of 2024, over the 12 months period, they have over-reported 818,000 jobs. That means to say what numbers the Federal Reserve is basing their forecast on, okay, has been faulty, because 818,000 is massive. And if you have 818,000 jobs missing, that was not even there, and they base their projection based on this, that means that all other projection will be in questions. We have known for a fact over the last 16 months, there were only 4 times the non-farm payroll number has been revised upwards. The rest of the time, it has always been revised downward. So the latest number that we have is 114,000 jobs. So whether come Friday, this number will be revised downwards, or that will be negatively being viewed by equity players. It confirms that the numbers coming in from the Bureau of Labor Statistics are not reliable to be based our projection and our pricing going forward. So this is a big hit, because this constitutes almost 30% of jobs that were never there. So this is something that I think the Federal Reserve did acknowledge, because on the 23rd itself, which is the Jackson Hole Symposium, the Fed chairman actually take note of this over-reporting of 818,000 jobs going into this release. This release was actually released 48 hours before his Jackson Hole Symposium speech. So we can see non-farm payroll. This is the latest we have seen. 114,000 jobs was the last number. This number is subject to revision. If it's revised downwards, that will mean that if this number is lower than 108,000, it will be the worst possible number for this year, 2024, up to date. Now, the expectation for the upcoming one tonight is 160,000 jobs. Now, if the number come in lower than this number, and this number here get 114,000 jobs get revised lower, it will have a negative impact on equity markets, because it will confirm what we are suspecting up to this the release of the Bureau of labor statistics saying that they are overstated employment. So this is something that we have to watch tonight. So be aware that these two number here, even though it has been released, is subject to revision. If it's revised downward, it's bad, and if the expectation 160,000 jobs is lower than expected, again that will be bad. Okay, last night ADP private employment change has been not as rosy, so we can see equity market did reacted not so well, although it did close positive. Okay. So this is the unemployment rate. Now, unemployment rate is clearly on the rise. Okay, before the August number, this will be, of course, coming in tomorrow. Market expectation is 4.2%. Currently, it's at 4.3%. If it comes in at 4.2, okay, it takes some pressure off. But if the number comes up anywhere near 4.3 or above, then again, that will be negatively viewed by market participants. Now, the question here is the US economy in recession? Based on the GDP number that was released last week, okay, this is the latest Q2 second estimates is at 3%, which is very, very good because just remember, US is a very mature economy, and if it's at 3%, if you annualize it, it is considered to be very, very good. However, based on this number, just be aware this number is updated every quarterly, so it is a bit lagging. We are in September, we are already in Q3. Of course, Q3 is not over yet until September ends, right? So, but Q2 number has been very positive. It basically means that compared to Q1, there's a 100% increase in GDP. So that means the US economy is doing okay. But the more sensitive periodic data that we've been seeing is telling us there is something else at work, which may actually point towards a softening of the US economy. Okay, so why am I showing you this chart? This chart is a unemployment rate relative to recession, US recession. And this chart go back all the way to 1948, even before I was born. You will notice that every time there is a surge in unemployment, which is this dark color line here, is always accompanied by a recession. Every surge in unemployment has been accompanied by a recession. The only exception here is this very sharp one. Okay, this is the pandemic unemployment rate. Of course, we have never seen the country totally locked down. So there was severe unemployment going into that period where the economy was locked down. That did not cause a recession because it was very, very sharp. I think only lasted 1 week, 1 month, and then before it comes back to normal. Okay, so we did not record any outright recession. But again, what we are seeing here is that there is that recession. Unemployment rate has been climbing. Okay, based on historical value, 4.3% is nothing. Okay, it's still considered on the low end because we have seen unemployment rate hit 9%, 8%, 10%. So those are the one that we have to worry. But the fact that this unemployment rate has been rising, every time you see a rise and then it surge, it always lead to a recession. So it is fair to forecast that going into 2025, we are very likely to see a recession, although there is no official sign that the US economy is in recession. But my fear is not recession. My fear is something bigger. Okay. We know for a fact that the war in Ukraine has been ongoing for 925 days already, and the war in the Middle East between Israel and Hamas has stretched to 334 days as of today. So this is telling us that a war in both places may contribute to the rise in inflation because war has always been inflationary. So we want to watch those fronts, not so much on the economic outlook, but on the other factor that may cause prices to remain elevated. One is war. The other one, of course, is external factor. We have the yen carry trade unwinding. A lot of people say that the 3 months of rally following the August 9 low that we see in the global equity markets has shown that the yen carry trade has been unwind, but nobody knows for sure how big is this yen carry trade. It is perhaps the most popular strategy employed by money managers for decades because the Japanese interest rate has been at very low end. At one stage was negative, and it has been the favorite what you call it borrowing currency. People borrow in yen and take the proceed to reinvest in other risky assets. A lot of this money goes into equity markets, okay? And it is no surprise that a lot of those money actually goes into US equity markets because the yield has been very, very good. So we want to see what else may happen. Of course, there will be other factors like the US presidential election come November the 5th. And my fear is that whoever wins, the other side will not accept the result. And that could only lead to more civil unrest. And that will be inflationary as well. Okay. So what I fear is not so much recession. What I fear is that prices will remain elevated for an extended period of time, accompanied by slower economic growth. So the soft landing scenario may not pan out as well. Okay, so just be aware. Now, this is the Nasdaq Composite Index. I know we don't trade this index, but this index is very telling because over the last 12 months or so, since the low in October 2023, we have seen that this market has been charging into new territories. Okay, the all-time high was traded one day after my birthday, which is 18,671.06. This refers to the cash index, and since then we see the market has experienced a bit of a drop. Now, during this phase when the market was going up, what was the main narrative? The main narrative has been ChatGPT, and of late it has been everything AI, and in particularly the NVIDIA represents the concentration of where the buying is actually done. Okay, so we can see that phase has been very, very extended all the way to 18,671. So this is where the market tops out. Now, during the first going into the end of August and the beginning of August, we can see there was a serious markdown in prices all the way to 15,708, and that bottoms out on August the 5th. Since then, the market has rallied, but the beginning of this month itself, in fact, the beginning of this week. Now, this week, of course, it started off with a Labor Day holiday, and on Tuesday, the market reopens and the market has been trading lower. So we can see the market may be resuming this downward move here. So I have a opinion that this represents the temporary top in the Nasdaq, and this is quite common for the other major equity index. And are we seeing a correction right now? I think there's a very good chance we are seeing a correction that may last all the way to just before the November 5th US presidential election. So we are looking at perhaps a 2 months pullback. And if that's the case, the low here on August the 5th, 15,708 looks vulnerable. So there's a good chance this low may be taken out and the next swing low will be over here. So you got to go to your individual chart and take a look at what this swing low here is for your whatever index you are trading. Of course, we'll be covering that during the webinar proper. But for now, I think this market may actually be doing this three-wave pullback. Okay, so short of a acceleration to the downside, I think this could be only be seen for now as a corrective pullback. Okay, and what's in store? Like I said, these are some of the topics we will covering. I'll be covering a lot more and in more details come the webinar itself. So be there when we do the webinar, and I will seriously encourage you because we are at that pivotal moments in which a lot of things going to change. There's a very good chance the year 2024 may not end on a very, very strong note. Yes, it has gone up quite a fair bit, but because of other factors that are in the news right now. Earlier on, I did mention three factors that may put a spanner into the wheel itself, and these are the things that I am considering. The other one is, of course, I did mention the yen carry trade. Now, there is no consensus how big the yen carry trade is actually. Some say it's $1 trillion. Some people say it's $40 trillion. So we have 3 weeks of bounce going into September. So to me, that is not really realistic to say that we have already seen the total complete unwinding of the yen carry trade. Now, if the yen carry trade is actually on the higher end of the estimates, which is $40 trillion, 3 weeks is not enough to digest. Okay, we are looking at some serious move here because there is that currency move that we want to be seeing, because the yen carry trade actually has more implication. Dollar yen continues to drop lower. It means the yen is getting stronger. As the yen gets stronger, it will have implication. Now, there are a lot of Japanese companies that operate outside of Japan. Okay, and if the yen continue to strengthen, they will have the incentive to repatriate all these earnings that they have back into Japan, and that means more yen buying. And if the yen gets stronger, it will have implication for the dollar. So if the dollar goes lower, obviously it is happening right now as we are speaking in expectation of the pivot by the Federal Reserve. So this is there will be a currency angle to this. Just watch the currency markets for signs. The other one, of course, is the geopolitics. Now, geopolitics is massive. We have one ongoing war in Europe that is already past 900 days, and then we have another war going on in the Middle East that is almost a year old. Okay, so these are things that we will have to watch very, very closely, and because wars are by nature very inflationary. Now, of course, we have another curveball coming up in the US presidential election. I did mention earlier on, whoever wins, it's not going to be happy for the other party. There is a very good chance that nobody will accept the result of the election. Okay, and knowing the voters' sentiment right now, okay, there is the risk of a civil unrest in the states. If the presidential election do not produce a clear-cut winner, or if the other party do not accept the result, this could be catastrophic for the United States, and that will spill over into equity markets. So just be aware of these three big catalysts that may actually influence not necessarily based on economics, but based on other factors such as the yen carry trade, such as the geopolitical and the domestic politics that's ongoing in the States, and of course, the outcome of the election itself. Okay, so just be aware. I'm not sure whether this date is the correct date because in my mind it's 25th, but Junhan, you want to confirm the date if it's 25th? If it's not 25th, I will do the correction here.
Yep. Hi. Okay. So, all right, Thank you, Mr. Daniel, for your insightful sharing. So basically, for those who are interested, so our webinar, it will be on 25th. Yeah, correct. And it's on Wednesday. So it's from 7:30 to 9 p.m. Yeah. So for those who are interested in trading our CME futures, Phillip Capital is actually offering a CME bundle product, which is involves indexes and commodity futures trading. So you may visit our website, phillip.com.my, for more information. So thank all of you for tuning in, and thank you, Mr. Thank you, Mr. Daniel, for your time. Yeah, I think that's
Thank you very
will.
much.
All right. Thank you.
All